네, 월가 트레이더 버니의 미국 주식 시간으로 돌아왔습니다. 앞서서 임순재 대표님께서 시장의 바닥에 대한 이야기를 좀 해주셨습니다. 진짜 지금이 바닥인지 아닌지 많은 투자자분들이 헷갈리실 것 같은데요. 미국 주식에 대해서 제대로 분석을 해주시는 버니 씨와 함께 이 시장의 바닥에 대한 이야기 나눠보도록 하겠습니다. 함께 보시죠.
So let's look at what happened now through the course of this first, say, 3.5 months of 2022. Let's look at the identification of market bottoms that we had in late January and early to mid-March and compare now and see where we're going. There's two ways we could go. We could turn this market into an up-rising market and going higher and higher, but we could also turn this market into a retesting of all these lows and see what's going on. I don't think, based on what we talked about before, that we're going into a rallying market. I think that may wait until the second half of this year. So what we want to think about now is, are there markets and are there occurrences within those markets that we can identify that that show whether or not we're near a tradable bottom? So we've talked about it before. We said there's really three things that we can identify at a tradable bottom. Very high degree of negative sentiment in the market, a preponderance of stocks that are trading down versus their moving averages, new highs, new lows, where they're making many more new lows than new highs, that sort of thing, and a complete lack of liquidity within the market. We had a lack of liquidity within the market in late January. We had a lack of liquidity within the market in mid-March. So what that lack of liquidity is when the bids and offers in the market are smaller than normal and far apart, relatively speaking. So what that's saying is that there's not a lot of people that want to take on a significant amount of size at current prices. They want to spread their bids and offers out a little bit more because they know that the volatility is pretty significant and they don't want to get hurt. They've obviously been hurt before. If they could make money on tighter markets, they would. So let's just take a look at the number of stocks that have made a new low relative to the basket of all the stocks. So when we look at this chart right here, we can see the top clip is the S&P 500, okay? And now what we have is we can look at the number of stocks that were down 10%, down 20%, or down 30%. So what we see is when their stocks are down 10% or more, that's obviously a negative occurrence, and that identifies with market bottoms. Down 20% and down 30%. So what we saw in late January and March is the number of stocks that were down 10% were 69% and 73% in March. Now NASDAQ had a much higher percentage of all these stocks, particularly in the down 20 and down 30, because the beta, the average amount of the stock moves relative to the market, is much higher for those NASDAQ stocks. You can make much, much more money in the NASDAQ stocks when they're going your way, but you can lose much more, so they have much more volatility. What we saw at the March lows is that we had a bigger increase in number of stocks down 20 and number of stocks down 30%. We almost doubled this number, but the number of stocks down 10% was still about the same because we were already at 73%. And there are some stocks that are counter-cyclical. Energy was a counter-cyclical space, and the financials for a while has been a counter-cyclical space. Those are now reversing back down as we've gone along. So what I think to find a tradable bottom is we need these levels to get back up to the high levels that we saw in March. Again, just revisiting the same general theme is we want to see what the percentage of stocks above their 50-day moving averages. Now, we have to think about this in context, because if the market's trading down really hard, okay, that 50-day moving average is going lower and lower. And it's easier to get on a rally to get above that 50-day moving average. If the market's going up and then flattens out over time and then goes up again, well, then when you're above a 50-day moving average that's going higher, that's a really positive stock environment. So what we saw at the beginning of December last year was there was a lot of stocks below their 50-day moving average, but they weren't that much below their 50-day moving average. There were just a number of stocks. And we pointed that out when we looked at the advanced decline line and the number of new highs, new lows. We saw the divergence in those when the stock market was making new highs in late November and December, and yet the number of stocks that were participating in those new highs was significantly off. What we then saw in late January was a significant drop-off of stocks above their 50-day moving average. Makes sense at the bottom. And then what we saw in March is that we only got to, say we got to 20% of all stocks above their 50-day moving average in March. In January, in March, we only got to 30%. So we actually had a higher level. But that's because some counter-cyclical stocks were doing better. We had the beginning in February, late February, of the whole Russian invasion into Ukraine, and so energy stocks took off, and they're in the market. So some of those stocks are not making new lows. We also saw the bank stocks do better all across this year into, say, about mid-March. Since then, they've rolled back down. But what this represents right here is the bounce off of that bottom in March when we had our first Fed rate hike. And right down here, we were at a very, very illiquid, low level of liquidity space in the market where the bids and offers were fairly far apart. So the market rallied substantially, but what it really did was it got back to the February highs. Basically, it took out the February highs that we saw for the first bounce here, but now we've kind of rolled back down. If we're going to see a bottom, I think we want to have this level, number of stocks above their 50-day moving average, a lot lower than they currently are right now. Finally, what we want to think about is, and when we think about a tradable bottom, what we've seen so far before is that we can bottom on the S&P forward PE ratios looking 1 year out. So in other words, we're estimating what earnings are going to be 1 year out, divided, take the price and divide it by that earnings estimate 1 year out, and this is where we get. Now, don't forget that in 1999 and 2000, we were way up here, so we had a high level of stocks in terms of high PE ratios. And as the market fell into 2002, this sell-off was even more significant than this sell-off in the NASDAQ space. But we chopped around here, and then we continue to go lower. Now, what we saw in COVID in 2018 is we saw these things go down significantly, and we haven't gone down. This is as of April 8th. We haven't gone down that much just yet. So our forward PE ratios are still relatively high. And if we want to think about market bottoms, we want to identify occurrences where that forward PE ratio goes down. So when it starts to go up, it's a surprise to us, and the market will continue to rally even further. We haven't gotten there yet.